Inflation is dead. At least that is what the headlines wanted you to believe in early 2025. But have you looked at the price of your commute lately? Or your latest utility bill?
It is a rude awakening, Liam. On March 28, 2026, the data confirmed what we have all been feeling. Inflation is not just high, it is sticky.
Sticky? That sounds like a technical way of saying we are stuck in a high-price trap. Today on 5 Min Smart, we are breaking down why sticky inflation is the new normal and what the 3.5% rate hold of the Federal Reserve means for your savings. Alice, we were told the no-landing scenario meant the economy would keep growing while inflation simply melted away. What changed?
The no-landing dream hit an energy wall. With the ongoing conflict involving Iran, global crude oil prices have spiked, acting as a massive inflationary weight. In February 2026, while we hoped for 2%, we got a headline CPI of 2.4%, and worse, core PCE at 2.7%.
So even with interest rates at their highest in years, the 3.5% to 3.75% range, the fire is not going out?
Exactly, because it is not just food and gas anymore, it is services inflation. Rent, healthcare and insurance have baked-in price hikes that do not care about pauses from the Federal Reserve. That is the definition of sticky.
I saw the latest projections of the Federal Reserve. They are still talking about one rate cut for late 2026, but the markets seem to be calling their bluff.
Traders are pricing out those cuts entirely. In fact, some analysts are now warning of a potential hike if oil crosses the triple-digit mark. The Fed is caught between a cooling labor market and a heating price index.
If inflation stays at 2.7% and the Fed stays at 3.5%, what does 2027 look like? Are we heading for a slow-motion crash?
Not necessarily a crash, but a great erosion. Think of it as a slow leak in your purchasing power. If you are holding cash, you are losing nearly 3% value every year, while borrowing costs remain punishingly high.
So the strategy of waiting for rates to drop to buy a house or start a business might be a trap.
It might be. We are entering the higher for longer decade. The era of cheap money is gone, replaced by an era where cost of capital is a real hurdle again.
This sounds daunting. Alice, what is the 5-minute action plan for our viewers to survive this sticky era?
First, hedge energy. Since energy is the main driver, look at your exposure. Second, reassess debt. If you have variable rate debt, do not wait for the Federal Reserve to save you. Third, diversify into hard assets. You want assets that can pass those costs on.
And most importantly, do not let no-landing headlines lull you into a false sense of security. The data is what matters, not the narrative. Alice, before we go, can you give our viewers one smart remark they can use at their next lunch to look like an economics pro?
Of course, tell your colleagues this. You know, the sticky inflation we are seeing right now is not just about prices. It is the market basically admitting that the target of 2% of the Federal Reserve might be a 20th century myth in a 21st century energy crisis.
Precisely. If you found this breakdown valuable, help us keep these insights coming. Hit the subscribe button and join the 5 Min Smart community. And if you want to support our independent research, check the Ko-fi link in the description. Your coffee keeps our analysis fresh.
Tell us in the comments, are you feeling the sticky inflation more in your groceries or your gas tank? Let us talk about it below.
Thanks for watching 5 Min Smart. Stay smart, stay ahead.